Health savings accounts, or HSAs, are one of the many tax-favored health plans that are uniquely flexible yet provide great tax advantages that may be potentially overlooked by many taxpayers. We're going to look at the case of Jane Davis, who opted for an HSA account instead of an employer-sponsored health plan and managed to save $700 in 2022 in both her payroll as well as income tax liability. But before we get into this, let's quickly go over what HSAs actually are. Those are tax-exempt trusts or custodial accounts that you set up specifically to reimburse your qualified medical expenses. Not every individual is eligible to set up an HSA, but this will come later in the video. The benefits of HSAs is that you put contributions into this account for your medical expenses, and the contributions that you make yourself are tax deductible. You can actually claim a deduction on your personal income tax return, and the contributions made through your payroll by the employer are not included in your gross income to begin with. And that's actually a great way to save on payroll taxes as well, because the contributions from your payroll that go automatically and are withheld by your employer are not subject to the Social Security and Medicare taxes. And we will see an example of that later. There are contribution limitations. So the total amount of contributions cannot exceed a certain amount. For 2022, the contribution limitation for the year is $3,650. Any interest or earnings that your accounts make are tax exempt, because those are tax-exempt trusts. In addition to all of this, the distributions that you take from your HSA to cover qualified medical expenses are not included in your income, so they're tax-free. Also, I forgot to mention that HSAs are portable, meaning that if you don't use the entire amount in HSA, it gets carried over from year to year without losing any amount of money. And if you change employers, this account goes with you, so you don't lose any money at all. So to become eligible for an HSA account, there are certain requirements that you need to meet. Well, first of all, you cannot be claimed as a dependent on any other tax return. Make sure that you aren't enrolled in Medicare, and in fact that you are enrolled in a high deductible health plan, or HDHP for short, and you don't have any other medical coverage, except for the constant exceptions, of course. And I won't be talking about the exceptions, but I will provide a link in the description box to the IRS publication 969, where you can look up those exceptions. Also, one caveat that I wanted to point out that seems to be important is that, let's say during the year you fail to maintain the high deductible health plan, but you keep contributing to the HSA. In that case, the contributions that you've made to the HSA while not being under the high deductible health plan will be added to your gross income, and you will be liable for taxes on that income. Also, one very important thing to note is if you take money from your HSA to reimburse your non-qualified expense, in that case, that money, that distribution, non-qualified distribution, would be a part of your gross income, and you will be liable to pay federal income tax as well as payroll taxes on that amount. And in addition to that, there is a 20% penalty for taking money from an HSA to cover a non-qualified expense. So be careful there. Make sure that your expenses that you're taking from HSA are all qualified, and make sure you save all receipts. So reporting HSA contributions and distributions require a few forms, and you will be receiving a few different forms from the trust or custodial account, and that information will be vital for you to prepare your tax returns. So let's look at Jane Davis, who opted for an HSA in 2022. So first of all, let's assume that she agreed with the employer that her salary for 2022, the entire year she worked at her workplace, is $100,000. And she contributed from her paycheck, from her payroll. The employer was withholding money to contribute to her HSA. So that amount is not included in your wages box 1 of W-2, And let's assume that she made $2,000 of contributions to her HSA. So first of all, she received a form 5498SA in box 2. She contributed $2,000. And in addition to that, she received a 1099 SA form, which shows how much of distributions she's taken. And you will see in box 3, there is code 1. It basically means these are normal distributions. Based on this information, we know that she has an HSA, and because of that, she needs to complete form 8889. Given this information, we know that Jane's employer withheld $2,000 from her $100,000 salary. This $2,000 is not considered her income and is also not subject to Social Security and Medicare tax. But let's also assume that Jane herself went online and contributed $500 to the HSA on her own, not through the employer, not through her paycheck. She just had some extra cash lying around and decided to contribute $500 additional to her HSA. This $500 contribution, we need to make sure that we take it out from the gross income on her tax return, because we don't want this $500 to be taxable. But unfortunately, because it's not taken from her paycheck, she will be paying Social Security and Medicare on those $500. Form 8889, you have to check whether it's self-only or family. In her case, Jane Davis is a single filer, so we check the appropriate box, and then in box 2, HSA contributions that you made or someone made on your behalf, but we cannot include the employer contributions. Those contributions would be reflected on form W2, box 12 with code W. So we don't want to include that amount in box 2. Only include the $500 that she contributed herself. And box 3 is basically the limitation. If she's under 55 years old and she's a single filer for 2022, the limitation is $3,650. If she was 55 years or older, you can add $1,000 to this limitation. Line 9, we actually include the employer contributions. And employer contributions is the contributions that the employer withheld from her salary. And that is, as I said, reflected on form W2. So $2,000, she agreed with the employer that this is how much she wanted the employer to withhold from her. The deduction that we can claim on her tax return is $500 that she contributed herself on her own. Let's also assume that she's taken $3,000 of distributions in 2022, and let's assume that all those distributions are qualified. Please keep in mind that if Jane had more medical expenses than what was available in her HSA, she would be responsible of paying the rest of the amount from out of pocket, given that, you know, after whatever her high deductible insurance pays. Okay, so we've determined that $500 that she contributed herself is an adjustment to income. It is a deduction that she can claim. We filled out form 8889. Now you can see this $500 being reflected on line 13 of part 2 adjustments to income, which is schedule 1. Schedule 1 reflects all additional extra income that's not on page 1 of 1040. Also adjustments, which are basically deductions that you can take. And on page 1 of 1040 form, you will see her salary of $98,000, which is her total salary of $100,000 minus the $2,000 that was contributed by her employer, but from her salary. That's why, and because we know it's not includable in her gross income, we don't include it. So we see $98,000 here. We see $500 from Schedule 1, that's an adjustment, and it reduces her adjusted gross income to $97,500. And here you can maybe ask a question on why is she taking a standard deduction of $12,950 instead of itemizing when she had medical expenses. Well, she could itemize, but remember the rule between standard and itemized, you can take whichever is higher. And so if she doesn't have any more expenses, and remember that medical expenses are limited to 10% of her AGI, in order to be able to take them on Schedule A itemized deductions. She actually doesn't really have itemized deductions. Let's assume she doesn't have mortgages, she didn't make any charitable contributions, and her state taxes are very low. Even though she has some significant medical expenses of $3,000, she wouldn't be able to take them on the tax return because the standard deduction is just more beneficial for her because it's larger, which reduces her taxable income to $84,550. Income tax liability is $14,224. Let's quickly calculate the Social Security and Medicare tax that she paid on $98,000. Remember, her salary is $100,000, but she's reflected as $98,000 on her W-2 because the $2,000 is the contribution not includable in the gross income. And so you will see that the Social Security, her portion of it is 6.2%. We multiply by 98,000 and we derive 6,076. It's a Social Security part of her payroll tax. And then Medicare is 1.45%. We multiply by 98,000 and we derive 1,421. Had she opted for an employer-sponsored health plan that is not high deductible health plan, and she doesn't set up the HSA as a result. So let's look at this. It's very quick, very easy tax return in that case. There is no Form 8889 to fill out, obviously, because there is no HSA. There are no adjustments. She cannot take any deductions. And her W-2 will actually reflect $1,000 of salary in box 1. And then box 12, I believe, will show the amount of the employer-sponsored health plan, I think with a code D or DD, I think one of those codes, but it doesn't really matter because the regular employer-sponsored health plans are don't really affect your tax returns. So you will see she will reflect $1,000 of her salary from W-2. There are no adjustments, there is no Form 1, and she's still taking $12,950 of standard deduction, and that reduces her taxable income of $87,050, and that results in $14,774 of income tax. But let's also look at the Social Security and Medicare tax that she paid on $100,000. Remember, she didn't have an HSA contribution this time, and that's why her salary is fully reflected on box 1. So you will see it's a very easy calc. 6.2% for Social Security times 100,000 is 6,200, and also 1.45% of Medicare times 100,000 of her salary, that gives you 1,450. So here you will see a comparison chart with HSA and without HSA. You will see that the Social Security, $124 lower if she has an HSA. Her Medicare is $29 lower, and her income tax liability is $550 lower. The overall difference, if you consider both payroll and income tax, Jane was able to save $703. So as you can see, HSAs can be a really good tax saving tool for some taxpayers. Obviously think about your own situation, whether it's worth having an HSA, depending on your health condition and the prescriptions that you're probably taking. You definitely need to think about that first before you think about tax liabilities. But I also want to point out a few things. So if you're self-employed and you don't have an employer who withholds the contributions from your paycheck because you don't have an employer, in that case you will be filling out the Form 8889 in a similar fashion, except that your contributions will be all reflected in line 2, where you saw the $500 for Jane. You will see those contributions there on that box. Your employer, because you don't have any, will have a $0 contribution, but unfortunately it doesn't change your self-employment tax. Slightly less benefit if you are self-employed, but at least it is available to you because there are some other tax-favored health plans that are not available to self-employed folks. So one last thing I wanted to point out about HSAs is what happens if a beneficiary dies. And a beneficiary is the account holder. So if you set up an HSA, you are called a beneficiary. So let's say an account holder dies, what happens? So if the person designated their spouse to be the new beneficiary of their HSA, the HSA maintains and retains its classification, and it stays as an HSA, and your spouse continues to use it as per usual. So let's say a beneficiary didn't designate their spouse as an HSA holder. In that case, the HSA will stop its classification as a tax-exempt account. Beneficiary will be liable for income taxes on the value of the HSA account. I hope this information was somewhat useful to you. My name is Lydia. I'm a New York licensed CPA, and on this channel my goal is to empower you by uncovering the mysteries of US income tax and broadening your perspectives. While this video and the channel overall are informative, they are by no means a complete tax guide and should never be taken as professional advice in any way, shape, or form, and the content is also not eligible for CPE credits. I hope to see you in the next video.